Good morning, everybody, and welcome to Retail Doctor Group's State of the Nation. This is edition 9. So we welcome all of our guests, and we've got a fantastic lineup of speakers this morning who we'll introduce in a second. A few pointers, so you can put questions through the Q&A function in Zoom or through the chat function, and we will ask the speakers as we go through the morning. So any questions you have for the speakers, put them in straight away, and we will ask those questions as we go through, hopefully keeping to time. The session will be recorded, so if you do need to leave early or you want to share it with your teams, there'll be a recording that will get sent to you later in the day that you can also share. There'll also be a podcast on the Retail Doctor Group podcast channel. So again, if you prefer to listen in your car, you want to listen to all those vital bits all over again, feel free to subscribe to the Retail Doctor Group podcast channel on Android or iTunes to get the content there as well. So firstly, I'd like to welcome Brian Walker, CEO of Retail Doctor Group, who will give us an introduction to our panelists.
Good morning, everybody, and thanks, Anastasia. This is State of the Nation 9, and it really morphed from our Retail Doctor Group CEO events. But really what we've always wanted to do with this program is to help our retail community through what has been a very tough and challenging period for many categories. And it's really with the help and support of people such as I'm about to introduce that this has been possible. So without further ado, I'm delighted to have Angus McDonald with us. Angus is a career retailer, NORA advisor, CEO of Barbeques Galore, and a retail leader, a true retailer in career, and certainly contributes a lot. And I think what's really fascinating about the Barbeques Galore business, as you know, is the transformation that Angus and his team are taking Barbeques Galore through, and really at the height of the pandemic. So some great learnings, and we're looking forward to Angus. Then followed Angus is Craig. Craig Woolford is the head of Citi Research. Citibank, we would know it as historically. Citi Research, Craig has about 50 analysts working for him. And if you know, ever get onto this information, it's really at the leading edge of what's going on in the analytics of retail. And there'll be a lot of trends that flow from that. Anastasia is our general manager and heads up our consumer insights. And you know, through the course of this and the work that we do in insights, here we've done a piece of work where we've looked at consumer insights, and very much compared it to retailer sentiment and looking at the gaps and then how to close those gaps for retailers. So I'm looking forward to that. Belinda McPhee. Hi, Belinda. Belinda is HR Consulting Director with TSHR. Fantastic person around the whole piece on human capital, if you like, leadership, what's going on, what we're experiencing out there. So we're looking forward to that. And of course, Joel Humel joins us. Joel is been with Retail Doctor Group as our financial, tax, all sorts of matters in accounting, but has some great insights and will bring us up to date with some of the issues as legislation brings through changes that impact retailers. So thanks to everyone, and we look forward to the session. Okay, so we're going to start, as Brian mentioned, with our retailer sentiment. So for those of us that have been with Retail Doctor and our research throughout the year, we've conducted retailer sentiment back in May, and then we ran the study again September, October to really understand how this has changed, what this means. And then we've looked at our consumer insights that we've been running throughout the year as well to understand how does this actually align with what the consumers are saying. So is there an alignment between what retailers are doing and what consumers are saying, or is there some key gaps that we can really learn from? So we start with looking at the 2021 strategy. So, I mean, we can see a whopping 90% of retailers have changed their operating focus for the next 12 to 18 months due to COVID. And what we can actually see is that this has increased in the recent months. So since our original research back in May, we've actually seen a massive increase to 50% in the last 3 or 4 months. So again, retailers are really understanding that this strategic direction and understanding what is needed for the next 12 months is so important. Consumers are saying that they really need a
they're looking for a clear purpose from their retailer, so a much deeper connection and a much deeper point of difference to spend that hard-earned dollars. I think what we're seeing here is this focus on strategy is so key to ensure you've got a differentiated point, a purpose for your brand, to really align to what your customers are looking for.
Yes, to that point, we've seen a healthy increase, and it really makes the point about not just tactical improvement, but really getting to the heart of what strategy is. And this healthy increase in retailers interviewed. So that's pleasing, because ultimately insights-driven strategy has to be at the foundation.
Then we looked a bit more into the store network, and we can see that 55% of retailers expect their physical store network to decrease, and 1 in 4 are cancelling new store openings. So again, this has really shifted quite significantly since the work back in May. So a bit more pessimism around the physical store. But then when we look at the consumers, we're seeing a much greater gap between this buying, transactional buying, and shopping. So really about this experience. So customers are still wanting this physical experience. Anyone that's heard myself and Brian talk, we talk a lot about the customer psychology, neuroscience, and that we're all, human beings at the end of the day with emotions, and consumers are really looking for that human experience. So I think we've got a bit of a gap there with what consumers are looking for in their physical experience. And I think it's understanding, what does that physical store mean? And what does it mean for the future? Is it around the hub and spoke, dark stores, pop-ups, and really understanding what your consumers are using your physical store for?
And that theatre is so important. And we talk about the 3 phases. Pre, that is all the research, which in terms of consumer insights, how consumers find the retailer, the consummation experience in the physical space, and then the post, which is joining into the community. It's interesting, of course, the neuroscientists would say that, though rather people would say we're logical beings that are occasionally emotional, and in fact we're emotional beings that are occasionally logical. So the physical environment has to be very emotionalized, as does the brand.
And then we look at the confidence for the future. And so what we can actually see is there has been very much confidence in the economic recovery has decreased. However, there is an optimism around the future trading. And we're seeing this in the way that consumers are behaving. So a term that I coined if you joined us for our last webinar, and that is going to be released in our research that I keep talking about, is shoptimism. And consumers are going out making these purchases to make themselves feel better. And it's not that consumers are not spending the money, they're just much more considered about what they are spending the money and what it can do for them. So I think this is quite a nice alignment with this confidence and optimism that retailers are seeing for the future.
I think the only thing I'd add to that is for retailers to focus in on transactional growth in this period. Really get back to those basics through this Christmas, New Year period in particular. Get back to those average transaction value, item per sale, just the good old basics of conversion and customer satisfaction, and drilling into online design and integration around conversion. That'll really be a driver over this Christmas, New Year. Every customer is gold. It's a matter of converting. Yeah,
and this is again aligning with that optimism. We're expecting a much quicker return to optimum performance. And obviously with the announcement yesterday, this might have changed again. So 1 in 2 expect optimum performance to be renewed within 12 months. So I think, again, are we prepared for that? Have we got everything in place? Do we understand that new consumer? So the consumer research that we talked about previously in our last State of the Nation really sort of showcased how much that consumer has changed in the last 12 months. So I think it's really been understanding what they are looking for in what I hate to use the phrase, the new normal. 50% of retailers expect in-store sales to decrease post-COVID-19. So this is probably quite static from where we were back in May. And I think this builds on what Brian was just saying about focusing on the key aspects.
What's interesting what's interesting to this point about transactional growth in this period is that we've seen levels of investment in training actually decline. Physical store training, the majority of retail will still be done in physical stores over this coming period and ad infinitum. But we've actually seen levels of investment in training of people in decline. So, you know, that we've got to really be thinking about reinvesting into our people in this period.
Mm. And I think when we couple this with the rise of click and collect, I mean, one of the stats that we saw was 1 in 5 consumers have used click and collect within the last month, and 1 in 3 have used it within the last 12 months. So this really is a rising trend that will not be going away anytime soon. So I think it's how we can, you know, build on that and then utilize the staff training, as Brian mentioned, and had to then convert when they physically come to the store to collect. So how can we utilize that further? And we're still expecting the growth of online. So retailers are saying, so 4 in 5 retailers expect online sales to increase. So we expect the online sales to really keep moving forward. So there's a lot of key questions there for businesses to look at to really make sure that they've got the correct internal systems, infrastructure, platforms to really manage this demand.
I think one of the pieces that's coming through this loud and clear too is pricing harmony between the channels, if you like, pricing strategy, getting that hero product category assortment right through this next period and being very clear on what that offer is. There's a whole debate about how large online sales will get. We certainly see post-COVID, post-vaccines and so forth, that pendulum will come back more towards the physical, but obviously with some increase. So kind of summarizing this into a couple of key points. Firstly, you know, listen to your customers. If you've ever heard myself or Brian speak, you know, this is the first thing that we say. Really use those customer insights to guide that strategy. Listen to what they're saying, listen to their behaviors, understand them in minute detail. So right down to personalities, motivations, drivers, emotions. As we talked about, this creating a retail experience is so much more important now. So really listen to them, to what they're looking for. Optimize your digital offering. So we know that consumers are spending over 4 hours a day on smartphones. 80% of our large purchases are pre-researched. So what is that digital path to purchase? As Brian mentioned, the 3 stages: pre-research, the point of consummation, and post. What is your digital offering across these platforms? Conduct a business diagnostic to ensure you are running at optimum health. So, you know, we're expecting to get back up to full strength within 12 months. So I think one of the things that's really key is looking internally. Have you got the most optimum systems, processes in place? Are your staff up to capability, as Brian touched on with the training, to really make sure that when we do return to full strength, that you're ready. And if there's less people through the door, then we need to be selling more to those that we have. So focus on transactional growth, covering items per sale, average transaction value, and all of the in-store experience, right down to the people and what we can get to really increase that sale when the customer walks through the door. Absolutely. And one last comment I would quickly add. We're always interested to see many retailers doing, and I'm on this sort of basics theme today through Christmas and New Year, linking sales forecasts to buying forecasts, making sure that there's good working capital management, because it won't be about profitability. It's always about cash flow. So keeping really tight in that area. Nice. And so just a quick summary, our retailer and consumer sentiment white paper, which will cover both the consumer side and the retailer side, will be available for download later today. So we will be sending out a link to everyone that's attended. And also we have got a podcast where we talk about the future consumer trends, which was released last week. So again, if you follow us on iTunes, Android, and I believe now Spotify. So fantastic. Brian, we are now Spotify stars. I told my teenage daughter we're on Spotify and she said, it sounds nothing like Justin Bieber, and I agree entirely. Fantastic. Thanks very much. Great summary.
So now moving on to Angus. So welcome Angus McDonald, CEO of Barbeques Galore, and to give us the retail leaders perspective.
Well, thanks, Anastasia, and thanks, Brian, for the update there. I think there's a couple of themes that I'll certainly touch on a little through my conversation here as well. But any discussion at the moment always seems to start with a bit of a reflection on the journey that we've been on over the last 9 months or so. And if we think about the COVID-19 roller coaster, right back to that, we'll just go to the next slide, there we go, right back to that early stage back in, say, early March, when everyone had their tinfoil hats on buying a year's worth of toilet paper. We had wild predictions of mass destruction of the economy, lots of really troubling signs on the horizon, and not a lot of certainty at all. As we've come down the roller coaster, we've certainly seen some really differing scenarios play out for different parts of the retail industry. Certainly there are some parts of the retail industry that have been really significantly affected, and thinking, fast fashion and other areas that have been really challenged. At the other end of the spectrum, there's been lots of durable goods retailers that have actually done very well throughout that time. And so what has been consistent, though, in all of those scenarios has been the importance of communication. And so when we've seen political leaders, think, prime ministers and premiers and others, getting out and doing daily press conferences, particularly during those early phases of the COVID-19 situation, within retail organisations, I'm sure many of us were doing much the same thing, and that was certainly the case for us at Barbeques Galore. It was really important early on to communicate very actively and clearly to all parts of the organisation as quick as we possibly could. Very important for us to make sure that our team members had confidence about the approach that we were taking, that we were providing clarity about the things we would and would not be doing, and making sure that we didn't have a situation where perhaps people in different parts of the organisation may be left to fill in some of the blanks with their own information. So there was a really clear and organised approach to make sure that we were communicating clearly, concisely, but broadly to all corners of the organisation very early on. Then, of course, filtering that back in through the organisation, making sure we had quite a coordinated approach. And so we were meeting regularly as an executive team every day, making sure that we had a consistent approach and any information was being shared as it needed to be across different parts of the organisation. And also really embracing some different methods of communication as well. Obviously, we had people working from home at different points, and so using things like Zoom, we've all become much more practiced at that, as well as also video messages and so on. But we were looking at other methods in terms of making sure we could reach all parts of our workforce, and particularly casual team members who perhaps weren't getting any hours at that particular point in time, making sure we were still engaging with them, and so communicating via the email addresses in our payroll system. We've also got a team engagement survey process, which is Tiny Pulse. We were using that to make sure we're collecting lots of insights and connecting with our team. So it's been really important for us to do that and make sure that we were giving that clarity of confidence and information to our team. Looking forward is then really a conversation of, well, what happens next? And we've gone from a situation where obviously there's been some really significant impacts to different parts of the economy, obviously lockdowns in Melbourne, but lots of other restrictions that have affected the movement of people. We're starting to now move into a little bit more of a normal phase, as much as there's still some restrictions affecting different parts of the economy. What I think many people are speculating now on is what will happen next year. And there's been lots of different projections and predictions about what may or may not happen, but there has been a couple of consensus themes starting to come through. And this is some information I saw from a presentation a couple of weeks ago, which I thought was a good overview. And I think we'll hear from Craig from Citi a little bit later on, who may add a little bit more colour to this. But the general theme was that we'll start to move back into a slightly more normal relaxation of restrictions and a bit more of a consistent environment from now on. However, there will be some things that just won't start up probably until we get to the back end of 2021 or even early in 2022. And that's really talking to international travel in particular. Even with the news yesterday about a possible vaccine being developed, that has to be manufactured, distributed, and that all takes time. The other thing, of course, is that people take months to plan overseas holidays, as an example. And so I think that we're probably still going to see a more domestically focused consumer over the next 12 months, people focusing on perhaps spending a little bit more money around the house. The other thing, of course, is people have not been able to visit relatives and other friends and the like. And so I think there's going to be a really strong focus on those social gatherings at home. We saw, I think last week from Coles, for example, talking about that trend around at-home dining, that's likely to continue. So I think we're going to see some of those things stay on beyond the relaxation of the restrictions we're seeing at the moment. And I think that's going to be a really important dynamic for all retailers to consider what that means for their business. In terms of a key trend that has absolutely come through loud and clear though, and I think Brian did touch on this a little bit earlier on, we saw a huge swing into e-commerce and people really embracing e-commerce for the first time in many cases, and huge increases in the mix of sales done through online channels. Whatever numbers that you're working to out there at the moment, inevitably, I think what we can all agree is that timeline around the maturity of e-commerce has absolutely been brought forward over this period. And while I think there will be some normalisation of what we've seen in the last few months, that long-term trend around the penetration of online as a percentage of overall retail sales, I think has absolutely been permanently accelerated. That's a really important shift for us to consider, and all the research that I've seen over the last little while, and there's obviously differing indications, but as a rough indication, online retail will represent about half of all retail sales growth over the next few years. Now, with this horizon being brought forward, I think we can only expect that may actually be higher. And I think that's really, really important to think about the way that translates into how we deliver an experience to our customers and how we embrace an omni-channel strategy in pursuit of that. Often these sorts of conversations are treated in a very binary fashion about online versus bricks and mortar, but many of us will know well that themes like click and collect, for example, are actually a really important way of connecting the two together. And for many traditional retailers, click and collect actually is a significant chunk of their online sales. And so the physical store absolutely still plays an important role in the delivery of retail experience, but there's no question that role has absolutely started to change. And so physical stores now do have a different role. They are much more about inspiration and experience. Many customers are getting the more rational parts of the process completed earlier in the purchase journey. So that online research that's happening, and depending on which segment of retail you're in, I think the general view is that around 80% or so of people are completing online research before they walk into a physical retail store. So they already have a sense of some of the technical information. They've probably already done some comparison. They've certainly checked pricing and product availability. And by the time they arrive in a physical retail store, they're looking for that inspiration and connection around the products, which is a different type of role than maybe the way that we've treated retail experience in years gone by. And so for us at Barbeques Galore, this has been something we've been very focused on. We have reduced the number of stores that we're operating overall. We closed a handful of poor performing stores earlier this year. We've since opened some new stores in improved locations, but overall we are operating on a net basis fewer stores than we were 12 months ago. However, those stores that we're opening in those new locations and the stores that we're refurbishing have a much greater focus on delivering a much more immersive and engaging experience for people who are looking to invest in our category. And particularly for us as a high engagement, high involvement category, that's something that's really important in terms of bringing that retail experience to life. The other piece is to think about e-commerce and the role that plays in how we deliver an omni-channel experience overall. And I must say, perhaps frustratingly, it's often when you talk to people about this particular subject, they lean straight into a discussion about digital marketing. And it seems to be very centered around that particular component of the equation. Particularly for omni-channel retailers, it is much, much more about getting the plumbing right in your organisation and making sure that all of the different parts of the journey are interconnected and are delivering a consistent experience and a consistent message. last year, when I joined Barbeques Galore, we were actually well on the pathway towards looking to implement a new e-commerce platform. And we actually decided to stop that project and instead work on the plumbing instead. And so we've actually focused on investing in the capability around our fulfillment processes and the way that we provide real-time inventory, recognizing how important that is in the delivery of that consistent experience. Just recently, we went live with our new order management platform to help support that investment. And it's only after getting those components right and making sure we've got the right equipment under the bonnet that we then return our focus to investment in that front-end customer experience. So I think that is something really important that must continue to be addressed. Many retail organisations, despite some effort, may still have a bit of a siloed approach in here, but there's no question today that the customer doesn't differentiate between those different distribution channels as they work their way through the purchase journey. And we've got to make sure that the plumbing delivers a consistent message at each stage through that process. Another theme that has really come through quite strongly, I feel, over the last little while, has been some reflection around some of the challenges in supply chain that COVID-19 has brought about. And I think it's important first to reflect on the journey that we've been on and how we've got to where we are today. And if you go back to, and I've got a picture of Deeming there, and others of his era that really pioneered a lot of the modern thinking we have around running an efficient supply chain, looking at improving quality through manufacturing, removing waste, and ultimately delivering the most efficient path to get the product into the right place at the right time. And so all of the work that many retailers have done over 20 or so years around improving just-in-time inventory, vertical integration up through the supply chain, all of that has delivered some unprecedented improvements in return on capital. The reality is that retailers today, compared to where they were, say, 15 or 20 years ago, are delivering more gross margin, more sales out of less inventory than they ever have before, despite the fact that obviously we're seeing increased penetration of things like private brand and other things. And so that's been a tremendous driver of value. However, at the same time, many retail organisations have actually traded off some of the flexibility that in times of uncertainty becomes really important. And, we're seeing at the Port of Botany some really unprecedented situations around port congestion with, weeks and weeks being added on the time to get product into Australia. And that's notwithstanding the further delays that we're finding upstream in China with, massive swings in demand from North America and Europe, which is really creating some significant congestion throughout the process. And so what we're finding ourselves in is a place where there is quite a significant delay in many, particularly in durable goods categories, in getting product into Australia. I'll just go to the next slide there, Anastasia. And then to the next one again. And so throughout this time, I think what has separated the good operations from the more challenged operations has been the quality of relationships with trading partners throughout that journey. Where we've had good relationships and we've had good strategic planning with our key trading partners, where we've worked together around developing ways of trying to reduce MOQs, improve some of the flexibility, making sure that we're producing ahead of time so that we can more efficiently and more flexibly move product through our supply chain. They are the places where we've been able to weather that storm in much better shape. There are other areas, though, where perhaps without the strength of those relationships, we've found it much more challenging. And I think the reflection of this experience is really to reinforce how very, very important it is to really focus on investing in the quality of those relationships, which absolutely provides more flexibility and resilience during times of uncertainty. And I think whatever we see coming in the near term, there's still certainly some uncertainty there, which we will need to all navigate our way through. The final thing which I thought I'd just touch on for a moment is just a bit of a reflection or a thought on what we see coming in the near term. So I mentioned before the longer view, a bit of a tapering perhaps of some of the significant growth that many people saw through the months of, say, June and July. And then into next year, I guess that new normal where, okay, we may see a more stable environment, but clearly still with some significant differences in the way that consumers are engaging with different parts of the economy. In the near term, of course, the question is, well, what does that mean for Black Friday and for Christmas? And I think this is going to be a situation this year where pretty much with many retailers, it's fairly easy to predict what they're likely to do. You just look at what they did last year and they'll probably make some refinements or improvements on that based on their experience and do that again this year. I think in many cases that's going to go out the window this year, and it's going to be a much more internally driven conversation around how retailers position for Black Friday, really driven by their situation. There's going to be some retailers that are constrained around inventory and are going to be looking to basically dial right back, reduce the depth and width of promotional activity, try and margin up a little bit, maybe give away some sales, but do that in a more sustainable way, given the constraints that they've got there. At the other end of the spectrum, I think there's going to be other retailers that have inventory that's arrived later than expected and are now highly motivated to make sure that they get out of it during the peak trading season. So I think we're going to see quite a volatile situation, quite different to the construct that many people have brought through last year and really driven by some of those internal challenges. On balance though, my sense is, and I think most other retailers I talk to are reasonably optimistic actually about what that near-term picture looks like, and will obviously be working to make sure that they pursue the opportunity in the way that works best for their organisation, given some of the constraints that many people will be navigating through. So interesting times ahead, and we'll all be watching really closely to see how the market behaves. But certainly from a customer perspective, I think there is some positive signs out there. I saw some research yesterday indicating that consumer confidence is at the highest level it's been in around a year or so, and that obviously bodes pretty well. So just a couple of closing thoughts. First of all, I think what many of us have probably reflected on over this time is never to waste a crisis. There's been really a unique set of circumstances, unlike any other time in most of our lifetimes, and that has absolutely given a really strong mandate to drive significant change if it is needed to be done. And that's been really a great opportunity to reset some things, challenge some thinking about, well, maybe this has been our strategy for the last 5 years, but let's really stop and think about whether that's going to work in that future environment and make the necessary changes that we need to make. And I think that's been really good at driving forward some more aggressive investment in places that we know are going to be important for the future, and omni-channel experience chief among them. The other piece, which I've touched on earlier, is really how valuable and important communication and transparency is, both with your internal and external stakeholders. And it may seem like an obvious observation, but I think we've absolutely learned through this time that the investment in time in really communicating clearly across all parts of the organisation and doing that quickly and in a timely manner has been really important to making sure that you can build the confidence and support of your team and key trading partners to support you through some of the uncertainty that we've seen. And there's still some uncertainty yet to come. So making sure that those conversations continue, I think, is a really important way to make sure you've got the commitment and support of all of those around you that are obviously so very important for the success of your retail organisation. So that's kind of it for me. Look, obviously some really interesting times ahead. Look, we're certainly having a lot of work coming to life in Barbeques Galore, and we're really proud of the journey that we've been on and really looking forward to the next few weeks of Christmas trading. But thanks for your time today, and if there's any questions, of course, I'll be happy to handle them.
That's a great summary, a great presentation, Angus. Thank you. I do have a question that's sitting around this omni-channel for the customer, but from an organisational point of view, and perhaps Belinda will talk about this later, but as we have, our employees in our offices, at home, and I think about this issue of how they integrate to produce an omni-channel customer experience, how they get to talk to one another, and what those new metrics might even look like.
Well, I think there's probably something just I'd add there, Brian, is how important, and I think we often when we talk about omni-channel, it becomes, again, I've mentioned before, a bit of a conversation about digital marketing. Second to that, a conversation about investing in technology. But actually, there's a much, much more important point ahead of all of that, and that's obviously about culture and the way that the organisation embraces a different way of doing business. And often one of the biggest barriers to that is about how you're setting and measuring KPIs. So I think the point you're touching on there about the way you measure success in these times, that is a huge enabler or a huge barrier for people to really go after this opportunity. I mean, a simple one, and it stuns me still that there are some organisations out there that are yet to really nail this, but you know, where stores still regard the online channel as a competitor. That is a disastrous outcome for any retailer if you have people in your organisation that either, you know, or actually actively discouraging customers from shopping online because they don't want to let those sales leak out of their store. I think that's just one example of a simple change that an organisation can make that can drive a huge difference in behaviour to make sure that they're actually motivated and excited to support the growth of this really important channel.
Yeah, really great. Thanks again, Angus. That's great. Anastasia, anything to add?
No, if we've got any questions anyone would like to put through for Angus, you can put them into the Q&A or into the chat function. I also will just quickly launch a quick poll. So as we go through, we're just going to ask a few questions in between our speakers. So feel free to vote and give us your opinion. We'll give it a couple of minutes, and then I will pull our presentation back.
Whilst this is occurring, I think one of the narratives of Angus's presentation, and so key with the leaders in our sector, is that really the subtext is we're talking about change management, change leadership, transformation, change, taking people ultimately, internal and external, through a complete new way of thinking about their brand, their offer, their roles. And I think that's what makes it so fascinating. And very shortly, we're going to introduce you to Craig, who I talked about earlier. Craig and his team of analysts at Citi are really talking about the effects of change at one level, change to the retail sector, the investor sentiment around retail, and of course, that's a consequence of consumer sentiment. So when we're ready, Anastasia, we'll introduce Craig.
Yeah, fantastic. So straight into it there with Craig. So welcome, Craig, Head of Research at Citi Research Oz and New Zealand. So giving us a bit of a summary.
Thanks, Anastasia and Brian. So it's been a good segue from Angus's presentation about what's gone on over the last 6 months, 9 months, and what might play out over Christmas in 2021. What I've got is a presentation that'll step through really some of the bigger questions that are coming. Some of them are very macro, very economic in nature, but also what are the structural changes? What are we going to see that's more permanent versus transitory in nature? And it is the case, there's people on this audience that will be experiencing great retail sales conditions. There'll be retailers that are still finding it incredibly tough, and I'll try and help explain what's driving some of those behaviours. To give you a few conclusions up front, we have seen the peak in unemployment, according to our economist. The peak was expected to be over 10%. Now it's likely to be 8% or less. So some good news there for the broader economy. And you can't underestimate, and you'll see some charts on this, you can't underestimate how much money has been thrown at this problem. Thank you to the government for getting through this, but you know, that stimulus has created some distortion and helped retail in certain parts. So retail has outperformed. It's our form of satisfaction. We've been told we can't do lots of things like travel, go to concerts. So we've been using a bit of retail therapy, and that will definitely continue in the December quarter. We're not concerned about a material slowdown, but we've definitely already seen the peak in retail spending. Now, the three big phenomenons are nesting. You know, we're going to stay at home, we're going to cook and do up our homes more, sure, but probably only for the next 18 months or so, because we do think the economies and vaccine will sort itself out probably by the end of calendar 21, and people will want to go and travel and eat out of home, for example. Online has accelerated. A great throwaway line, we've had 3 years of online growth in the last 9 months. So we've pulled forward some of the structural change that have been happening there. But there is a consequence to that, and we will see retailers shutting more stores. So if we just page forward, I'll just step through why retail sales are so buoyant now. So this chart, some audiences I've shown this to get a little bit frustrated because it's still quite aggregated, but bear with me. So we're really looking at 4 parts of retail, and this is, you know, holistic, as in every retail segment falls within one of these categories. but it's either an at-home necessity, so your food, liquor's been a necessity through COVID, pharmacy, and then out-of-home food is obviously the reciprocal of that. We've seen huge falls in spending there. Housing-related retail has moved in one direction, and anything to do with the department stores, apparel, fashion, accessories has moved in a slightly different direction. Just reflect on it. The bottom row has non-food retail, and in the month of July, total Australian non-food retailing grew 19% year on year. This is an enormous figure. We haven't seen growth of that sort of magnitude in peak retail conditions. We haven't seen that sort of growth in the last 30 years. So despite a pandemic, despite concern, despite all the economic commentary that has been fearing a shakeout across the economy and retail as part of that, we have seen amazingly good retail conditions. Now the 19% has stepped down to 7 to 8%. Really the housing related categories have come off their peak. Some of that necessity and spending has come off, but it is important to think that people will still continue to switch their spending between some of the retail categories as things reopen. So I mentioned, if you want to think of a three-legged stool in how retail spending transpires near term, say for the December quarter, in 2021, and where things settle medium term. We've got the income side of the equation. I'll step through the spending side of the equation, and the third leg to that stool is how people choose to save versus spend. So, as I mentioned up front, the stimulus that's been provided by the government is just enormous. In the September quarter, $89 billion has flowed into households' bank accounts. We do include the superannuation withdrawal. Technically, it's not a government payment, of course. It's your own money that you've withdrawn from your super. But we have seen somewhere in the order of $18 billion come in through that form. We've got JobKeeper that's been quite significant, as well as even the cash flow payments for businesses flowed through to a lot of sole traders and non-incorporated businesses that have therefore benefited to household balance sheets. So here's the stat for you. In the June quarter, Australian household income rose 8% year on year. Normally, Australian income would rise 3 to 4%. So better than normal. We earned more money as Australians in the June quarter than we ordinarily would. But it's only thanks to the government. If you strip out the stimulus, household income would have fallen by 9%. So we haven't got those same statistics for the September quarter just yet from the Bureau of Statistics, but you can see how we've tallied up these stimulus measures on the chart here, that it's a bigger source of income growth in the September quarter and then steps quite a bit down in the December quarter. But realistically, it's not till the June quarter of next year that meaningful stimulus is unwinding in the economy. And it's that quarter that I guess we're most concerned that there is a lot of retailers that will have to lap some very large figures. So I mentioned the three legs of the stool. We've just talked income, now I'll talk spending. Retailers, I think, are guilty, and hopefully this, if there's a lesson out of COVID, this is one of them. We need to think about spending in its broadest definition. Consumers don't just think, I want to buy either an item of clothing or an electronic device. They're thinking about where they get their satisfaction in say, discretionary spending. So in Australia, we spend just over $1 trillion. There's about $200 billion that's spent in discretionary retail. There's another $200 billion that's just spent in discretionary non-retail categories. Choosing to go on a holiday, choosing to go to a concert or a sporting event, or getting the dry cleaning done, or haircuts. There's lots of things that we do that are discretionary non-retail purchases. Now, because those discretionary non-retail purchases were essentially, we were told we can't do a lot of those things. We've been forced to stop a lot of spending there. Some of that, not much actually at this stage, but some of that has pivoted into retail. So the discretionary non-retail bucket in the June quarter fell by 45%. In the September quarter, it might be down 30, 35%, still a huge drop in spending there. And as a result, retail spending is doing better. Households have more income sitting in their, more cash sitting in their bank account, but the drop in discretionary non-retail spending has been enormous and created oxygen for retail to outperform over the last 6 months. So the third leg to the stool is the savings rate. And here's where I'm most positive, but also most uncertain. So normally households will save somewhere between 3% and 10% of their income. The long run average is about 8.5% of our income. As asset prices rise, mainly house prices, people will save less. So the most recent observation before COVID was savings rates were sitting about 3.5% of your income. So people weren't saving that much. Now COVID hits, we get extra income from the government, we can't spend on holidays. Our savings rate skyrockets up to 20% in the June quarter. And over the calendar year, 2020, we'll probably save about 10 to 12% of our income. So the good news is, as that income leg slows in calendar 21, maybe households will draw down a bit of that savings to continue spending in retail and other areas of the economy. It's more likely to happen if we have house prices rising and unemployment falling, which feels increasingly the case. And to round out the broader macro conversation here, we're in an environment where most categories that have benefited the most from the spending outlook, housing related retail might be the row you want to look at on this slide. That's the category that's going to find it the toughest as we head into calendar 21. And realistically, the growth rates that we're looking at here are still very good on a 2-year basis. Don't be misled by the minus 11% in the June quarter. When you grew 22% the year before, that is still very strong growth on a 2-year basis, and dollars of sales are still quite elevated. Those categories that have seen the weakest growth, out-of-home food is the obvious one. We'll see a rebound as economies reopen and they lap bigger numbers. But again, it's still not quite at the level of spending versus 2 years ago. So calendar 21 will be quite subdued, but be mindful about the subcategory messages here. It's really going to depend on whether you operate in a cafe or restaurant, a department store, an apparel retailer, or a housing retailer, or a supermarket. They're going to be very different levels of growth. Overall, retail spending will slow quite a bit, but in the scheme of things, not necessarily a bad result, particularly in light of broader economic weakness. Okay, so I'll talk about the financials. Our day job is analysing retail companies and talking about the prospects to large investors. The best performing stock in the retail sector is Kogan, share price up over 100% this calendar year. Now, yesterday, the share market had a massive rotation, as we would call it, because the vaccine may be more imminent and more effective. So online retailers have seen a drop in their share price. Don't be I guess, misled or confused or distracted by that conversation. Online retail growth, as you can see on this chart, was trending at 10 to 15% pre-COVID, skyrocketed up to 80% growth. It's tapered off to high 70s now. Once we have Victoria reopening, it might be 50 to 60% growth. But these growth rates are still more elevated than when we were pre-COVID. Statistics from Quantium or NAB, Post, everyone's showing that there's more Australians that are shopped online. And once you start shopping online, you then increasingly shop more categories and shop more often. So online growth has boomed. The page forward, the online penetration for most listed retailers sits at a decent level. But if you use this chart, if you look at the right-hand side, let's look at non-food. It's probably easier and more intuitive to think about the total non-food retailing industry, and we can strip out supermarkets and the delivery phenomenon. So online non-food is sitting at about 17% of all spending. And there are, if you eyeball across the chart, there are some retailers, Myer, surprisingly, Premier Investments, Citi Chic are all seeing pretty good results in terms of their penetration online, but there are others that are still behind. And Australian listed retailers will continue to push to try to catch up in terms of online sales growth. I think if you reflect on it, we now get approaching $1 in $5 of sales going online for a bricks and mortar, the non-food retail industry. One question that's not happening yet, and probably won't happen this calendar year because the elevated online growth rates are just so good. So I think people aren't focused on it, but they should. It's not clear to us on any dimension that online sales are incremental. And it really matters. If you've generated a sale online that came out of that sale that was going to happen in store, then it has a very different conclusion in terms of the profitability that it provides the business. If you think of a sale as incremental, you're probably not allocating a lot of the costs that go into your business, say the above the line marketing costs. Think about the rent in your stores, think about some of the overheads in your business, people costs and buying teams, etc. So a lot of retailers do tell us that they're profitable online, but we know those retailers are thinking of it as an incremental transaction. The big retailers dominate their categories. Woolworths and Coles represent 90% of all online sales. They represent about 80% of all 75% of all bricks and mortar sales in supermarkets. So it's highly unlikely that much of their sales are online. And if we make that calculation, we conclude that online is not profitable for a lot of retailers. And there's two ways to solve this. One is you charge explicitly for online. So you make sure that the total cost of that transaction appropriately reflects the cost to the customer. Challenging to do, free delivery is pretty commonplace above a certain threshold. Or you think about how you shut and reduce those bricks and mortar costs. If the sale has come out of the store and now you've got 20% of your sales online, then maybe you need 20% less stores. Probably not quite that dramatic, but I think retailers need to start contemplating the implications. Last little bit on retail is just around the operating leverage that we're seeing. And you'll see a chart here. Food retailers have kind of struggled to show operating leverage. And there's two dimensions. One is they definitely didn't want to show that they were gouging or making excess profits through COVID. And rightly, they put a lot of protection for their employees, protection for customers to make sure that shopping at their supermarkets wasn't a dangerous activity. So we've seen elevated sales growth, but not elevated profit growth in the supermarkets in the 6 months to June. It's getting a little bit better now. They're getting more efficient in how they manage some of the COVID costs, and the PPE costs are already in the base. If we move to the next slide, it was quite different. Discretionary retailers didn't need as much COVID-related protective costs, PPE, and gross margins tended to be a little bit better, a little bit less discounting, and there were rental subsidies for a lot of these retailers. So, despite, for Premier Investments as an example, clothing had found it tough. Sales were down 18% in the 6 months to June, but they managed to generate 11% profit growth. I think a debate that's still wide open, and again, I don't expect any resolution this calendar year, is what happens to rents. Some retailers with this online growth that they're seeing are more likely to shut stores and therefore more willing to follow through on the threat that they don't need that store and may successfully generate lower rents. But in the main, retailers are actually making plenty of profit. So it's going to be very difficult to argue for lower rents in an environment where their profit margins are up. So these store closures are not really pervasive. All we're seeing is retailers that are in a really difficult financial position. Think Flight Centre, think Target, and to a lesser extent Big W. They're shutting big licks of stores. We're talking half of their store count. So the good news is the economic disruption from COVID is probably behind us. Unemployment has probably peaked, but we've had a lot of stimulus. So retail spending is tapering off. We don't think it's a cliff. We think it's a taper, a fade. We've seen trading up behaviour maybe as we enter 2021, there'll be a bit more trading down behaviour as the forms of stimulus taper off as well. And really the structural change that I've just stepped through is really the same structural changes I could have talked to you about in 2019. They've just been accelerated. Online becomes a bigger part of retail. Retailers choose to shut more stores. The only structural change we don't think will persist beyond calendar 21 is the out-of-home food phenomenon and the nesting phenomenon, which we think should start to rebound in calendar 22. That's a wrap, Anastasia. Happy to take any questions from Brian and yourself or anyone on the line.
Thanks, Craig. Yeah, we do have one question that's come through. So do you believe the economy will go back into recession in 2021-22?
The economy is unlikely to go into recession. So GDP growth will rebound. I think it's tricky. Remember the pie chart, retail only represents about a quarter of the economy. So the three quarters of the economy that's going to drive a GDP rebound in calendar 21 are going to be things that have been shut or significantly disrupted from COVID over the last 9 months. Whereas retail, we've been trading in the main, particularly anything out of home in the home categories or supermarkets, and the stimulus that we have isn't there, and maybe we will be able to go to a concert or a sporting event like that. We're travelling overseas, maybe we've got a few bubbles to Japan and New Zealand.
Fantastic. Okay, so sorry, Craig, I put all the slides in there.
Can I ask Craig one quick question, time permitting? The topic you raised, Craig, on online profitability is a really interesting one, isn't it? Because when we think about sort of the apportionment of costs to brand, and brand resonates in the physical environment, staff costs in physical in a true omni-channel environment, there is a bit of a blurring of the lines. What's kind of interesting to me is that, you know, we know that almost 60% of all global online is owned by 6 companies, 4 out of China. 40 to 42% is the balance of online. I actually suspect the true profitability, that fundamentally it's more unprofitable than we give it credit for. It's just the way we apportion the costs. Know your view on that generally?
Yeah, so the one of the big debates that's rightly being asked around online is where is the scale benefits?
Yeah. And
we are starting to see, your big behemoths like Amazon or eBay in Australia still have huge amounts of traffic. Traffic is one of the biggest costs. Now, we know that paying rent in a shopping centre is one of your biggest costs, and you're kind of buying traffic in the way you pay rent. So what we find is profitability gets eaten up pretty quickly for a small or medium-sized retailer that has to spend a lot of money buying traffic to get to their website. If you are absorbing delivery costs, you're probably giving away or incurring another 10% of sales. So your traffic or your marketing cost might be 10% of sales, your logistics and delivery cost might be another 10% of sales. So you're quickly eating up the saving that you thought you had from rent. But guess what? You're probably still paying for the rent in your store because you haven't shut the store yet. So it's a real challenge.
It is a challenge, and it's interesting to see some landlord debate emerging about what is theirs to clip the ticket on and what is not. So as retailers start to think about, dark stores and opening out of the back of physical assets that they're paying rent on, even that gets a bit blurry after a while too.
Sure.
It's interesting times, isn't it, Craig? What a great summary. And, for those amongst us who might not know Craig's work and his team's work, I really encourage you to get onto the newsletters, the work they do. Craig's supported us and likewise for over 10 years, and a really great piece of analysis. So thanks, Craig.
Thanks, Craig. That was great. So I'm just going to throw in a quick question while we move across to welcome Belinda McPhee, who is the HR Consulting Director for TSR. I always say this wrong, Belinda, apologies. TSHR Consulting. I'm trying to say it too quickly. Fantastic. So Belinda's going to give us a bit of an update on business leadership through COVID. And as always, any questions you have for any of our speakers, pop them into the Q&A, and we will ask them as we go along. Fantastic. Okay, welcome, Belinda.
Thanks so much, and good morning, everyone. Well, I think we can all reflect and say, wow, what a year to be a leader in a retail business or any business. And certainly from the leaders that I've been talking to and partnering with over the last 9 months, there's certainly a general theme of, in some cases, excitement because innovation has been forced upon many businesses and many ways of doing things, which is really exciting and energizing for leaders. But then also there is this general theme of exhaustion and, you know, wow, how are we going to move into 2020? So what I thought I would do is just touch on some of the key themes around leadership for 2021 as we move into the next year. And I think it's safe to say, touching on what Anastasia was talking about earlier in her section around purpose-driven, you know, brand experience, it's fair to say that purpose-driven employee experience is going to be equally important. So having that whole notion of what I would call human-centered leadership is really the key themes that we're going to be seeing throughout 2021 in terms of how leadership evolves across all levels throughout organisations. So I thought I would share with you some research that's come out of the World Economic Forum over the last few weeks around the shifting view of how human capital is valued. So again, just to reflect and support some of the conversations throughout the webinar today, there is going to be a whole shift away from profit in terms of, again, how human capital is valued, to more purpose-driven assessments of, you know, again, organisations and their value and their worth and what drives employees in terms of motivation, attraction and retention. The other key element is around corporate policy. So the traditional elements of, you know, what I would loosely call command and control in terms of very strict policies and procedures in terms of how people conduct business. Of course, there'll be some foundational requirements that will need to be in place. But what's really shifting is the move towards social responsibility, which in an organisational setting is really all about having a values-based framework to actually, you know, set up what's right and wrong in organisations in terms of, you know, how people conduct themselves. So that's going to be really an important shift from the more transactional way of doing things to, again, having more values-driven approach to that. The other key approach is doing things, you know, standalone. There's a real shift around the ecosystem, and I think we saw some of this during COVID. So if we look at some of the local examples of Qantas and Woolworths partnering together in terms of redeploying some talent. So some of the stood down Qantas employees were being redeployed into Woolworths as they were, you know, peaking through their time. So that's an example within Australia, and overseas within Germany. There was a terrific example of Aldi supermarkets partnering with McDonald's to do the same thing. So as obviously McDonald's was winding down its business due to lockdown in Germany, Aldi partnered with McDonald's to obviously take on some of their employees. So we're seeing more and more of a shift around that true ecosystem and leaders partnering at the very top level. And then there's also going to be a shift away from, you know, the traditional notion of an employee and a job to people, work and skills, which again is really about having purpose-driven approaches to the employee experience and also empowering the talent within the business to bring their best to work. So having that real level of inspiration around work rather than, again, going back to the traditional methods of command and control. And then again, without spending too much time on the rest of the slide, moving away from seeing, you know, your workforce as an expense to an asset, and to the question that Brian raised earlier around metrics. So there's a move away from, you know, backward looking and traditional and in reward cases, individually based metrics to more value and future-based metrics that look at, you know, team contribution and longer-term value creation, rather than looking at some of those, I guess, more transactional, short-term time horizon metrics that are typically assessed today. And they're going to be looked at over a longer time period, rather than looking at, you know, short, sharp intervals of reward. So that's just some high-level shifts around how human capital is going to be viewed. And the reason I wanted to talk through that is it kind of links back to the behaviours, and again, what's the real shift we're seeing around, top leadership behaviours. So again, linked to some of the previous discussions we've had today, again, what do leaders need to do, and what do team members really want, and what do stakeholders across organisations want, is that strong ethical and safety framework. So again, making sure that people are kept safe, businesses are kept safe, and there is a framework to make sure that those high ethical and moral standards are in place. In terms of organising, it's moving away again. I keep on coming back to, telling people what to do, to allowing people to self-organise. And Angus talked about it in his presentation, the whole notion of very clear and regular communication around expectations. So that's going to be incredibly important, to allow people to self-organise to be able to move forward. And COVID's been a great example of the whole notion of learning and being able to change very quickly. So efficient learning and responding quickly and changing how we do things is, again, critically important. And again, the other two key elements is about nurturing growth and around connection and belonging. Again, very, very important themes, which link back to that whole notion of human-centred leadership. So again, this is just a bit of a recap of what most leaders obviously work towards and deeply understand and know, but leading with emotional intelligence is going to become more important in the future than it has been traditionally. So what do we mean about leading with emotional intelligence? There's that whole notion of, as leaders, making sure we've got high self-awareness around our strengths and our characters and how we behave. And in my experience, I've worked with a lot of leaders who are very successful throughout their careers and get to the end of their career and still suffer from a degree of a lack of self-awareness. And quite often that's because they've never had the opportunity for people to deeply give them feedback throughout their career. And so what a lot of top leaders are doing for themselves and their teams at the moment is going back and doing a deep diagnostic around their own skills, their own strengths, as a leader, to then be able to have that awareness around what are their triggers, where are their strengths, to enable them to, again, fulfill that whole notion of human-centred leadership. So that then allows them to, again, move on to the second step, which is around, regulating their behaviours and being able to be aware of, what their triggers are and to avoid that, and to be their best self as leaders, rather than, again, just relying on how they've always led over, the last 10 plus years of their career. And that then supports their ability to be personally motivated whilst also motivating a team, and having a high degree of empathy and social skill. And that's really the key to what team members are wanting and what successful leaders are bringing to the table. So this is just an important recap in terms of leaders addressing team members' needs. So historically, there would be, and Angus referenced it, in employee surveys, pulse checks, and historically some of the older styled assessments looked at employee opinions or employee satisfaction. And what's really happening in the whole movement of leadership and the employee experience is there's a movement away from simply looking at satisfaction to deeply looking at engagement, and then taking engagement to the next level, which is looking around inspiration, because inspiration obviously generates that performance level, that discretionary performance level that you want above and beyond for team members and for leaders. So again, moving away from how satisfied are my teams to are they truly engaged, and more importantly, are they inspired? And as leaders, what are leaders doing to drive inspiration and driving engagement? The other key element that leaders need to focus on is that whole notion of connection and contribution. So the employee experience isn't just a single dimension experience that's, focused again on the employee being satisfied. It's all around experience linking to an economic outcome or contribution within the workplace. But the key role of successful and great leaders is to connect the whole notion of the purpose of the organisation. So again, what's the purpose of the organisation culturally beyond just making money? Because it's a given that organisations exist to make money, but beyond that, why do organisations exist outside of that? That's a question that a lot of people ask through the recruitment process. And then again, linking the notion of work and reward to support that total employee experience. And the other thing that is a trend towards 2020 is around simplifying talent management. Businesses don't have a lot of time to focus on, some of the more longer term historic ways of modelling and measuring talent. But the key three themes that allow you to maximise your talent from a leadership perspective is really focusing on and putting great attention on better hiring, focusing on smart retention, and that's not just retention for retention's sake across the board, but making sure that your best and brightest are the key people that you are focusing on retaining. And then from a training and development perspective, the key themes are around stretch development and looking at more experiences on the job and looking at that traditional 70-20-10 learning model, where the most learning that's valuable for team members is on the job experiential learning, and then also learning through coaching and mentoring rather than the traditional classroom based learning opportunities. Something else that I thought I would just point out too, because it does have an impact on leadership and that whole notion of better recruitment, is what are the recruitment patterns during COVID? So if this is some information that was from Seek a few months ago in Australia, and you can see that earlier on in the year in terms of what was happening in January and February, there was an equal amount of supply and demand of talent within the market. And then you'll see the top line, which is pink, is candidate availability. So naturally during those lockdown periods, those high periods of unemployment, there was a readily pool of available talent. And then on the bottom, you'll see that the amount of jobs that were available to support that declined. We're now at a point in August, September, October, and now November, where that has normalised again. And businesses were going into the notion of Christmas recruitment to say there's, an abundance of talent in the market, only to find that there's, again, in some cases, a scarcity of availability of talent. And the other trend that we're finding is, particularly at store level, the recruitment process is moving very, very quickly, where traditionally you might have had 12 months ago a 1 to 2 week window of turning around the recruitment process at store level. We're finding that now it's a matter of days. So if you're not offering, someone interviewing and offering within a 3-day period, you've lost that candidate. So that's moving really, really quickly in terms of the speed of recruitment. The other thing in terms of the candidate experience and how leaders affect this is important just to call out. Because candidates have greater expectations around moving to a new job, they obviously aren't going to rapidly make decisions around leaving roles, particularly pre-Christmas. There's a whole lot of conversations that are happening in the market with talent looking to make a move in the early new year. So I think a lot of businesses will be in for a bit of a surprise in the first few months of the year with people actually wanting to make a move, because there's lots of discussions happening across the market. But if people are wanting to make a move, they're really wanting to make sure that what their offer is for their new opportunity is in line with, their personal needs. And some of those needs are around, naturally job security, but also the whole notion of flexibility. And what does the brand deliver to me? Because there has been some trust erosion in the workplace. So people are really wanting to, again, connect to purpose, feel deep trust towards the brand that they're going to be moving to, and the leaders that they're actually going to be leaving and moving to, and making sure that, when the opportunity presents, they do have greater flexibility and they do have more time for themselves. So that's really a trend that we're starting to see ramp up now, and will certainly go into the new year. And the other notion is around what I would call, the gig economy and temporary based workers. So in the US, the trend is something like 1/3 of the workforce fall within the definition of gig workers. And certainly within Australia, we're seeing lots of demand for short-term, freelance, temporary, consulting-based opportunity, short-term assignments to help businesses, again, be more nimble with their cost base. The other notion which was touched on earlier by Angus was around the expanded use of technology. So we're seeing lots of use of technology through the recruitment process, and some businesses, particularly overseas, are using artificial intelligence at the early sourcing stage of recruitment. So technology is a great enabler around hiring, and it allows you to get through particularly volume recruitment quite quickly. But certainly from the candidate experience, what we're hearing is the human factor isn't going anywhere. So candidates still want to talk to someone, build that emotional connection with the hiring manager, the leader, to make sure that, you know, they're making the right decision around making their next move. The other thing that we're seeing is the rise of video screening. So the whole use of Vimeo, you know, short video clips responding to interview questions to fast track the whole recruitment process. And again, the use of artificial intelligence to data mine and to quickly assess the candidate base. So that's certainly trends that aren't going away. And the other use, Brian referenced it earlier, that there seems to be a decline in training. One of the clever responses to that, which some businesses are entering into, is the use of virtual reality for training. So again, typically face-to-face training has been in decline. Even in-store training, which is obviously reliant on, you know, having groups of people together, that's hard because of social distancing. So we've seen a decline as a result of that. But virtual reality is starting to take over some of those demands and moving away from that content-rich e-learning experience that is usually around written text to more engaging, you know, video-based training. The other thing that we're seeing is a greater reliance on psychometric assessments. Because there's, at the front end of the recruitment process, there's going to be more reliance on automation. Getting the appointment right at the back end is critically important. So psychometric assessments, so that's looking at assessing people's work style to match your culture, and also looking at assessing people's cognitive abilities, is increasingly being used at the front end to recruit people, but also being used for internal promotion and succession planning to make sure that, you know, leadership appointment is appropriate, and also is being used to do some of that self-assessment and diagnostic that I talked about earlier for existing leaders to assess where they are and to be able to work on their development plans and improving their leadership capability moving forward. And lastly, we're seeing a greater use of virtual support for employee wellbeing due to the whole notion of an increased reliance and requirement to support mental health, and digitally ensuring that there's employee engagement and employee communities, which Angus also referred to earlier, which is critically important, particularly at store level. So in summary, the key trends that we're seeing is around keeping people safe, secure, and appreciated. That whole notion of human-centered leadership. So again, moving around, you know, the purpose. So why are people joining organisations? Why do they exist beyond making money? Leaders making sure that there's greater humility and compassion in terms of how they actually lead. Ensuring greater authenticity around how leaders engage with their team members and the broader community, and having that great open communication. Focusing on the employee experience. So again, Anastasia, you know, spoke about some great references around the customer experience. There's equally as much activity around really drilling down into employee insights and, you know, and making sure the employee experience reflects the organisation's needs and matches that to the customer experience. Flexibility becoming the new norm. Again, it's not going away, and lots of organisations, including, you know, large retailers, are offering, you know, flexibility above and beyond what they've offered traditionally, and having the expanded use of technology, but also balancing that with the human factor. And then overlaying all of that is, again, the rise of diversity and inclusion as a theme, and again, making sure that reward and how people are recognised is linked towards, again, that more human-centred authenticity rather than the more transactional. So that's what we're seeing in terms of leadership trends.
Fantastic, Belinda. Really great stuff. So thank you very much. And we really increasingly have placed more gravitas on the employee and the leader experience through COVID, through change. And Belinda, wonderful insights in that area. Thank you, as ever.
Thanks, Belinda. So now moving on to Joel Humel from Grenfell to give us a bit of an update on the business and stimulus packages available. Hey, Joel.
Thanks, Anastasia. Just today, I'm just going to briefly recap some of the government assistance being offered to businesses, including the unlimited immediate asset write-off, your tax losses being able to be carried back, and tax cuts for individuals, and what the government's trying to achieve here. So on slide 2 there, we've got the immediate asset write-off. So anecdotally this year, among some of our retail clients, we're seeing a restructuring of their business, a small realignment. We're talking about that strategy piece that Brian and Anastasia mentioned earlier. For example, maybe moving to deliver product or package product, perhaps linked to online sales. So now, this can involve, of course, the purchase of new equipment or machinery, which the government is trying to encourage with this immediate asset write-off. This is passed into law now, the immediate asset write-off for assets installed and ready for use between the 6th of October 2020 and all the way out to 30th of June 2022. So any business with an aggregated turnover under 5 billion can claim an immediate deduction for the full cost of any new equipment asset purchased during that period. So there's no asset limit, again, just to confirm that. And even for second-hand items, the immediate write-off applies. So for businesses with an aggregated turnover of less than 50 million, second-hand asset purchases, they're unlimited. There's no limit on the cap. So for businesses with aggregated turnover over 50 million, we still have the $150,000 write-off cap. It still remains in place. So if we move to slide 3 there, just a reminder of what does this mean for business? So the amount of tax saving, of course, is the asset multiplied by the purchasing entity's tax rate. So for example, for companies with an aggregated turnover under 50 million, the tax rate is 26% this current financial year and 25% in the coming 2021-2022 financial year. So for example, if we had Aussie Sporting Goods Co. has a turnover of 45 million and purchases a new delivery truck, say for 100,000, the reduction in their tax is 26,000, being your 26% tax rate times $100,000 cost of the product purchased, the equipment purchase. So now this benefit is realised on lodgement of the 2021 tax return. So it's not something you get on the spot. You've got to wait for that tax return to be lodged. And we don't get back on tax what we spend. We get back what we spend times our tax rate. So a quick side note, when we go to sell these assets, these large assets, down the track as second-hand items, please be aware that the tax office expects you to declare the proceeds on the sale of that asset, that delivery truck or packaging machine. Now, we also have had questions from our clients about what this means for buying a car. So with the purchase of your average car, as opposed to a truck or piece of equipment, don't forget the car depreciation limit applies of $59,136. So according to the Australian Taxation Office, this means you can only claim the business use percentage of the car limit. So if you buy a car for $80,000 and you've got a 50% business logbook, you can only immediately write off 50% of the car depreciation limit of $59,136. You can't claim the full $80,000. The instant asset write-off on slide 4 there has effectively been replaced by this immediate asset write-off. But just to recap, that $150,000 instant asset write-off concession is available for businesses purchasing assets from the 12th of March 2020 to date. Slide 5, tax losses carried back. So obviously with many businesses in certain segments of retail, we've had a downturn for them, and therefore they'll have tax losses. And even businesses that maybe are doing okay, they might be able to create a tax loss by the purchase of a new piece of equipment using that immediate asset write-off I've just talked about. So the government has passed into law new rules allowing companies to carry back any losses made in the 2020, 2021 or 2022 financial years and offset those losses against any profit made during the 2019 or later financial years. The goal being to generate an income tax refund for these companies. So basically, if you made a profit during the 2019 financial year and the company paid tax on it, you can offset any loss made during 2020 or 2021 year and claim it back as part of the tax paid on your 2019 tax return as a tax offset or refund. So slide 6, disappointingly, it's only for companies. So sole traders and those trading through a trust are out. And further, there's a bit of a wait on this because it's claimed through the tax return. So you have to wait until the lodgement of your 2021 and 2022 income tax returns to take advantage of that measure. Importantly, the loss carried back, this whole thing is limited to the company tax you've paid already. In particular, to be specific, the company's franking account balance. With our individual tax cuts that were announced in the budget, this is all about the government trying to stimulate consumer sentiment. So the government and Treasury, they believe they still believe there's pent-up domestic consumer demand out there, and that'll be unleashed with the relaxing of COVID restrictions, the low interest rates, and hopefully a vaccine announcement. And of course, some tax rates on top. Now, these tax cuts take the form of changes in your personal income tax brackets to put more money into people's pockets and increase spending. So we're looking at, in that table there, the 19% rate, that the top bracket, the top threshold has been moved from 37 up to 45. And for the 32.5% tax rate, that's been moved from 90 up to 120,000. So on slide 8, as an example, what does this mean? So your gross salary for someone being paid 45,000, they pay $1,080 less in tax. Likewise, someone with a gross salary of 80,000 pays, because they're on the same tax bracket, $1,080 less tax. Whereas your gross salary of 120,000, they're on a higher tax bracket, they get more of a benefit of $2,429 in less tax. So this is meant to be in place. These tax cuts, of course, are meant to be in place in your pay run for November. And so employees should start seeing a increase in net, which hopefully, it's trying to stimulate more consumer spending. Lastly, we'll just talk about JobKeeper. It's still out there, and it continues for businesses with an actual turnover decline of 30% when comparing the September 2020 quarter to the September 2019 quarter. So we'll just remind people, don't forget to check the alternative tests to check your eligibility. We still have time to get our October 2020 JobKeeper declarations in. The closing date on that is this Saturday, the 14th. Where the September quarter 2020 figures are soft, we're seeing prior to figures, prior to when we compare them to earlier quarter figures this year, the application of the following alternative tests we've found produce results. So the first alternative test you might look at is where business that has had a substantial increase in turnover. And the second alternative test is where business that has an irregular turnover. Now we know that we have the anticipated JobKeeper payments, not just for October, November, December, but January, February and March of 2021, which we might again qualify for. So we need to keep our eyes on your December 2020 quarter figures compared to your December 2019 and your prior quarter numbers for this calendar year. So don't forget to run some numbers through the alternative tests in early January, particularly if your turnover has fluctuated through different months and quarters in the 2020 calendar year, because you might find that in the new year, you qualify for January, February and March JobKeeper. Finally, basically you can see where this is going. The government believes that with the tax cuts combined with low interest rates, easing of COVID restrictions and hopefully a vaccine rollout, that they're hoping to create a spike in domestic driven economic activity. That's what they're banking on, the government. So it's not impossible that the economy has a mini domestic spike in the first half of 2021. Of course, like the downturn, not everyone will experience it evenly. And like Angus and Craig mentioned earlier, it's got to be set against issues such as inventory levels, and the reduction in government spending, which is slowly occurring. Anyway, I'll leave it there. That's my piece for today. Anastasia, I'll hand it back to you.
Thanks, Joel. That was appreciated. That was a nice quick summary and kind of gives everyone a bit of an overview of what's going on and what to look out for. So we'll bring to a close our session today. Thank you to all of our speakers. It's been some fantastic content this morning. We are closing our Australian Retail Innovators nominations at the end of the month. So if you haven't yet put your nomination in, please visit our website or our direct link there, as you can see. I'll also put it in the email that I send out to everybody. So feel free to nominate yourselves or to nominate somebody else that you feel is doing really well in the sector. So nominations close at the end of November. And we will wrap it up there, I think. Brian, anything further to add?
I have to acknowledge you, Anastasia, as a facilitator and organizer of these events. This is the 9th and also a major contributor. Thank you, and to everyone at RDG for your contribution. And I was just thinking about the 9 events that we've put. I'm tempted to suggest a best of in December because they've been phenomenal. Such great speakers all the way from Bernie Brooks, Anthony Grice, through to Angus today, Joel, Belinda, Simon with property. Fantastic. Not only showing the knowledge, but showing the capability. So we'll make sure everyone's details are out and about and contact each, and we always encourage clients and colleagues to contact our subject matter experts and to help each other through this period, which, you know, there's some amazing results that have occurred as we've seen. So on behalf of myself and the team, thank you very much. Look forward to the next one.
Thanks, everybody.
Thank you.